Welcome back, class. This is Chapter 3 video that I promised, and I'm going to go through the material that's in Chapter 3 for your review. This will help you perhaps as you prepare, but also as you go forward. So looking at Chapter 3, we begin with the accounting period, and we have a 12-month fiscal year that we're working within. And that fiscal year is going to be based on when our business year is a natural business year. So for a golf course or maybe even a lawn mowing business, this natural year, January through December, might work because our busy time is going to probably start in spring and go through fall, but we're not going to be actually out doing a lot in December probably. So we will be able to do these work on the financial statements and look at things like inventory and so on. However, if we're in the retail business like Target or Macy's, we're going to be our busiest in October, November, and December, so we probably don't want to set ourselves up to issue financial statements on December 31st. That's going to be too hard to do. So Target and Macy's chose January 31st. Likewise, if you had a ski resort, you'd be busy in October, November, December, probably January and February. So you'd want a fiscal year maybe out here in June or July somewhere when you're not at your busiest. And then you'd have time to work on the financial statements. So we're talking about the difference between the accrual basis of accounting and cash basis. Now, accrual basis is very interested. In fact, this is the central concern with accrual-based accounting, that we match up revenues and expenses based on when the revenues are earned and match the expenses that go with those revenues in each period. For an accrual-based system, what we're going to do is we're going to take a payment that we make and examine it and figure out just what periods is it going to benefit. For example, in this exhibit, they talk about paying $2,400 in prepaid insurance that's going to benefit 2 years in advance. So they pay $2,400 for 2 years insurance in December of 2018. Well, it will benefit December of 2018, but will also benefit all of 2019 and most of 2020. So what we want to do is allocate these costs between the fiscal years in a way that makes sense. And if we're paying $2,400 for 24 months, then $100 a month makes a lot of sense. So in 2018, we're going to recognize $100 of insurance expense. In 2019, $1,200. In 2020, we'll recognize $1,100. On the other hand, if we were doing cash-based accounting, we wouldn't care about that. We would say, okay, we paid out cash in December, so we need to record that cash payment in its entirety in 2018. This distorts the earnings that this business is making if you're running it on a cash basis, because not all of this $2,400 is actually going to apply to 2018. So the principles that we're using are the revenue recognition principle that requires us to recognize revenue when we provide the goods or the services, and we have an amount expected to be received from the customer. Likewise, with expense recognition or the matching principle, we're going to match those expenses for the accounting period that they benefit and match them with the revenues that are recognized as a result of the expenses. So if we're incurring expenses that relates to 2019, we should recognize some of these expenses here on the accrual-based system. So when we talk about adjustments, that's what we're doing. We're trying to realign the accounting system in a way that we match up those expenses with the revenues we're earning. So when we defer expenses, what we're doing is we're putting some expenses in prepaid expense, which is an asset, and as we use them up, we credit the asset, prepaid, for example, prepaid insurance, and then we debit the expense account, which is the insurance account, insurance expense. So as we go through these adjustments, here's an example for the prepaid insurance. We have a credit of $100, a debit of $100. And that's going to be and that's based on how long those expenses will benefit the company, or when they will produce the revenue, when they match up with the revenue we produce. Supplies are similar. So when you look at supplies, you're looking at basically somebody will purchase a large quantity of supplies. They'll put them in a supply cabinet or closet. Somebody will monitor those and make sure that they don't run out. And when they are looking at those, when they're monitoring those at different points, they'll do an inventory to find out what the value is in that supply closet. So in this case, they had purchases of supplies that are going to add up to a total of $9,720. If you total the debit here, that's what you're going to get, $9,720. And then they did an inventory in December 31st, and they figured out they had $8,670 of the supplies left. Well, that's what you want the balance to be. So you're going to take that balance and subtract it from the total supplies you had to begin with, and that's the difference, $1,050. You can think of it another way. You want this balance to be $8,670, and right now it's $9,720. So what do you have to do to the supplies account to make it happen? You have to put a credit in there of $1,050 in order for that to reduce to the $8,670 that we want in it. And likewise, when you credit the supplies, you have to debit supplies expense. So we basically are, with supplies, we know how much we purchased, but we'll do an inventory to figure out what we have left, and the difference is what we're going to adjust. There are other prepaid expenses as well. You may have prepaid rent or advertising or something like that, but those are going to work just like what we've talked about with prepaid insurance. You'll have some way of allocating those costs over the years. Depreciation is another cost that we need to adjust for. And when we talk about depreciation, what we're talking about is when we purchase a plant asset that over time it loses some of its value. And we need to recognize that loss of value, but also that as we use it, we are recognizing some expense that goes along with the revenue that equipment is going to produce. So, for example, if a hospital purchased an MRI machine, or maybe one of them that I remember, I don't know why I do, but a lithotripter, it's a device or a machine used to break up kidney stones. But if they purchase one of those machines, they're going to depreciate it over the length of time that it will provide service and earn money for the hospital. So this depreciation is not based on how long it'll last, but it's based on how long it will produce revenue. So in this case, when the example that they're showing, they purchased equipment for $26,000, and they're going to use that to produce revenue with. It has a useful life of 5 years, and it's going to be worth $8,000 at the end of 5 years. That means the net cost is $18,000. They depreciate it using straight line depreciation. It allocates amounts of the asset's net cost throughout the period of its life. So really what we're doing is we're saying, okay, this asset costs $26,000, but we're going to use a little bit of it every year, a certain amount of it every year, in order to make money, to make income, and we're going to show that expense in our financial records. So if we take the $18,000, divide it by 5 years or 60 months, what we're going to do is depreciate $300 a month. So in this journal entry, to adjust for depreciation expense, what they're going to do is to debit depreciation expense and credit accumulated depreciation. Now, you never credit the asset for equipment account. Instead of crediting the asset, we want to put it in an accumulated depreciation account, which is a contra account to an asset. And the reason why is we want a permanent record of how much we spent on that equipment. This is the cost we paid for it, not what it's worth. but we're estimating how much we've used up over time with this accumulated depreciation account. We will show the equipment minus accumulated depreciation on the balance sheet in order to show what the value of that equipment is at any given time. But when we credit this accumulated depreciation, which reduces the net value of the equipment on the books, what we're going to do is increase depreciation expense for equipment. In other words, we're recognizing this expense over time. And so that's what our adjustment will be, a debit to depreciation expense equipment and a credit to accumulated depreciation equipment. So accumulated depreciation is a separate contra account. It's always shown on the balance sheet and in the trial balance next to the account that it's associated with. But the contra account simply means that this account is the opposite of the asset account for equipment. So it's an opposite. With this kind of treatment, we're basically adjusting for depreciation and showing the reduction in the value of the asset without actually touching what we have the recorded cost as. So here's the presentation on the balance sheet. And this would be our net book value for equipment. Okay, so when we talk about revenue, we're going to defer revenue too. If we receive cash and we have not delivered the services yet, if we get an advance on something, we're not going to show that as revenue. We're going to show it as unearned revenue. And what that means is that because we've received an advance payment, it doesn't mean that money is ours to use. What it means is we may have to pay it back if we do not perform the duties that they ask us to. So we receive some advance on our revenue on consulting, and if we wind up with the company without doing anything with that contract, we'll have to refund the money. The great example here for unearned revenue is a concert where you've sold all the tickets and then suddenly the artist canceled. You'll have to refund the money on those tickets to the people that purchased them. At least you might have some fees, but you'd have to refund it. And so that revenue isn't yours until you actually host the concert and the people actually see the event. So that's the same thing for unearned revenue. As we go through accrued expenses, what we're going to do is we're going to recognize expenses that we haven't paid yet. So when we defer expenses, we are deferring expenses that we've already paid. When we accrue expenses, we are adding expenses that we haven't yet paid, but recognize they should be on the statements in the year or period where they have actually helped to earn this money or revenue. So accrued salaries expenses are going to be based on our evaluation of when the pay periods are, for example, in a business. And I don't know about any business you've worked for, but most of the businesses I work for do not end on December 31st. The payroll does not come out on December 31st. Typically, it's a later date. Well, in this case, that's exactly what happens. And we cross over the end of the period. See, they show a payday here of 26th of December, and we have 3 more days in December where we're going to have some salary expense that we should be paying for, but we're not going to pay for it until we get into January. So we're going to create, or we're going to allocate, we're going to figure out how much expense occurs on those 3 days. And then when we do, we're going to debit salary expense and credit salary payable. So we're basically moving that expense into the present, even though we haven't paid it yet. Accrued interest expense is the same thing as accruing the salaries. You're going to recognize the amount of interest expense that you owe and that you're going to have to pay, even if you're not paying for it right now. So you could wind up with a calculation on accrued interest payable where you actually have something similar to what you did with payroll, where you say, okay, well, my last payment on the insurance or the interest was in November. I'm going to pay on it again in April or May, let's say. Okay, for November and December, or for December, I need to account for part of that interest in the December 31st statements. So you're going to calculate or prorate the amount, whatever it is, and then basically put that in the current year. You'll show a debit for interest expense and credit for interest payable. Sorry, I just had a blank there. Anyway, credit for interest payable. So anyway, those are the things that we will do with that. Then we accrue revenue. And again, this is not deferred revenue. Deferred revenue is where we receive the cash but we haven't earned it. Accrued revenue is where we've earned it but not recorded it. So when we're doing an adjusting entry and we're accruing revenue, we may have a contract that we've performed part of the contract. So we sign a contract, and the example here is they've provided 20 days of service in December for this contract that they signed on. So they performed these services and they've earned it. So you need to move it from, you need to record that. Whether or not you've received it or not is irrelevant. So you recognize through a debit to accounts receivable and a credit to consulting revenue that you've actually earned that revenue. Interest revenue is the same way. You're going to accrue interest revenue if you have, if you're a bond owner, for example, and you have some bonds out there and you're going to collect that interest, you're going to record that. And then when you accrue the revenues and in the future you receive them, you're actually going to record it like this. You're going to debit the cash, and the amount that you've already recorded will be in accounts receivable, and the cash you receive could be larger than the accounts receivable, and if it is, you're going to put that into revenue as well. All right. When we talk about adjustments, there are going to be 4 basic adjustments that we're talking about. We're going to defer expenses. That would be like prepaid interest or prepaid insurance or supplies, where we purchase the supplies, but we're not going to recognize them yet. When we do recognize them, the adjusting entry will be a debit to expense and a credit to the asset. We're going to defer revenue, and this is a case where we've received some cash, but we haven't earned it yet. So we're going to debit the liability, which will be unearned revenue, and we're going to credit the revenue account. On the case where we're accruing expenses, and this is going to be like with a wages adjustment, we're going to debit the expenses for the wages that have been earned but not paid, and then credit the liability related with that. And then finally, with accrued revenue, this is where you're basically accruing a revenue that you haven't received yet. So you've performed a service, but you haven't received it from a customer. So this is going to be a debit to accounts receivable and a credit to the revenue account. Okay, so for the next thing that we want to talk about here is a trial balance and financial statements. When we get to the trial balance is merely a list of all of the accounts in our chart of accounts with their appropriate balance in those accounts. So we're going to identify, for example, all of these assets here, cash, accounts receivable, so on, whatever their balance is. And we're going to show the liabilities and the capital. And then we're going to get down here and we're going to show dividends. That's the amount we're paying to the stockholders. We have a consulting revenue amount here, which is basically the revenue we've earned in the business. And then we have all of these expenses underneath that. Whether there's anything in those expenses right now or not, those are still there. So we have that unadjusted trial balance. Now when we adjust it, that's when we're moving things around for the accruals and deferrals that we've been talking about. So we're going to, for example, debit the receivable here in letter F and credit the revenue, because we're recognizing that we've earned that revenue even if they haven't paid us for it. So these other adjustments we've already talked about, so I'm not going to beleaguer them, but what you're going to do is you're going to take the beginning balance, debit balance, plus or minus what you have in these columns, plus a debit minus a credit, and you get that amount. You're going to do the same thing for all of these. And as you go through this worksheet, this visual representation of a worksheet, you'll be able to see how that fits together. When we prepare financial statements, there is a specific way to do it. We have to prepare them in a specific order, or else it won't work. We start with the income statement. In the income statement, you are going to look for the revenue account and then take everything from revenue on down below it. So here you have two kinds of revenue. You're going to add that together for total revenues, and then you're going to list these out. But you're going to show a subtotal for the total revenue, and then you're going to add these together as another subtotal for total expenses. And then you're going to subtract these expenses from the total revenues. And when you do that, you get a financial statement that looks somewhat like this. This is the income statement. So you're starting at the bottom of the trial balance, and that's the income statement. Then you work up the chart until you get to dividends and common stock. So these amounts are going to go into the retained earnings statement. Now, when you're doing the retained earnings statement, we're going to start with whatever the retained earnings were at the beginning of the period, and then we're going to add net income that we computed here. We computed this net income, or no, not here, down below. I'm sorry, I was looking at the balance sheet. Down here, we've computed the net income. We're going to bring that up into the statement of retained earnings, add that to the beginning retained earnings, subtract out dividends, and then we'll have our ending retained earnings number. And then we move everything else. This is, by the way, retained earnings is going to go in the capital section with capital. But then we're going to move everything else over to the balance sheet. And when we do, we're going to have a problem, because when we get to the equity section, it won't balance, because according to the balance sheet, retained earnings is 0, and we've just computed that they're $35.85. So we need the retained earnings number to come back into the equity section so we can actually balance this balance sheet. So we have accounts that are permanent. Those are the ones that will go on the balance sheet. We'll keep them around forever. They are assets, liabilities, common stock, and retained earnings. The temporary accounts are the ones that go on the income statement, and then also we're going to have dividends and a special account income summary that we're going to create just for the closing process. So when we record our closing entries, we're going to set up this temporary holding account called income summary, and that will allow us then to close all of the revenue accounts. And they have this really very good 4-step process here. We start by closing the income accounts. So if an income account has a credit balance, no, not income summary, the income account right here. If they have a credit balance, we're going to put a debit into revenue, and then we're going to credit the total into income summary. Likewise, when we close the expenses, they have all debit balances, so we want to credit each one of those and then debit the entire total into income summary. And what you'll have in income summary then will be actually a calculation of the net income that we've calculated on the income statement. You'll then move that net income Out of income summary, you'll debit the net income, because we have a credit balance there now. We'll debit it in income summary to close income summary, and then credit retained earnings. And retained earnings, we're going to begin with a zero balance. We didn't have any to start with, but we're going to add in the net income and then reduce that by the amount of dividends that we paid. So here we paid $200 in dividends, so our net balance in retained earnings is $35.85. So now we have all of the pieces we need to do the balance sheet. By the way, before this, before you actually adjust the retained earnings or do a retained earnings statement, you will not know what the retained earnings should be on the balance sheet, because the number that's on there, if you use it, it will not balance. You need to have you have to calculate the retained earnings for the balance sheet. So when you actually do the journalizing of these entries, it's going to look like this. You close revenue, close expenses, revenue to income summary, expenses to income summary, close income summary to retained earnings, and then close dividends into retained earnings. Because you're going to have a debit balance in dividends, you're going to credit this 200 and debit retained earnings for 200. So they give you the steps here, very clear, very well ordered. And then post-closing trial balance is really the last thing that we do. And when we do this, we're actually taking only the accounts that remain open. So you're using only the permanent accounts to do this post-closing trial balance. And basically what you want to prove is that you've maintained all the debits and credits the way that they should be in these accounts. So as you list them out in this trial balance, you'll find that they balance here, or at least that they should. Okay, the last segment here talks about the accounting cycle, and really there are these 8 steps. But basically you're analyzing the transactions, you're journalizing them, you're posting them into the ledger, you're doing an unadjusted trial balance, you adjust the trial balance, you prepare an adjusted trial balance, you adjust and post the accounts, and then you prepare an adjusted trial balance, do financial statements from the adjusted trial balance, and then you're going to close the accounts, prepare a post-closing trial balance, and then if you've entered any kind of a transaction in the adjustments that requires a reversal, you'll do the reversal entry. The last thing they talk about is a classified balance sheet. This is the one we talked about in class. Basically, the only thing I'm going to say about that here is it groups current assets together, long-term investments, plant assets, and intangibles. It separates them out by type. And one of the reasons is that when you're doing financial statement analysis, it's much easier to use this because you have total current assets and total current liabilities. And those are comparable. So that's really it for the Chapter 3 video. If you have any questions about this, I'll see you guys on Monday.